Hey guys, wanted to talk to you today about, is the housing market going to crash in 2023? Well, we really need to go back and look and compare it to the market back in 2007, 2008, when we saw the last crash or the last reset of the housing market, and see what were the causes and what were the outcomes of that after everything happened. So let's look at the housing market back in 2008 and compare it to the housing market in 2023. When we look back at the crash in 2008, we need to consider what were the causes of the crash and what was the opportunity after the crash for those who bought homes low and made significant gains in equity. Because remember, up to the point of 2007, 2008, we did see considerable gains in equity. In some states, it was as high as 60%, maybe even a little bit higher than that from what house prices had started at. So this created a frenzy for people going out and buying properties. I mean, you'd see a single entity. I knew people personally that owned anywhere from 50 to 55 properties that were financed with subprime loans. So think about that. If that person doesn't have hundreds of thousands of dollars in reserves to cover those payments, if they say, let's say they had 20% or 30% of their renters move out and they had to make the payments on those rental properties, well, they're not feasibly going to be able to because their coffers aren't full enough to make those payments. So what are people going to do? They're going to walk away from properties. There was also a lot of other causes to that 2008 crash for the housing market. They were related to overbuilding of homes due to the values increasing in the same states by as much as 60%. In some states, additionally, banks were approving loans at 100% stated income and only requiring 2 months reserves, regardless of how many properties you owned. So that is a key factor, not to mention other subprime loans. And most loans didn't require reserves or little to no reserves, maybe a month or two, just like the 100% stated income. So the other issue you've got there is people did not have skin in the game, which means they didn't have any of their own money put down in these houses. So it was easy for them to walk away from these properties, especially when they own 10, 20, 30 properties, with one person, and they just didn't have their reserves to cover those payments. So that was a big factor in the housing crash. Not to mention, you had a lot of people called straw buyers, where they would just use their name and credit, and these builders were able to go in, get credit lines through the banks, and just build subdivision after subdivision. And because of the gains were so much, they were building so many properties, everything was so overbuilt at this point. So when this crash started to come to fruition, the prices started to drop. Even though the rates were low and they were keeping rates low and the Fed was dropping the rates to try to stabilize the housing market, you still had too many properties. So we were way overbuilt for how many buyers that we had, because you had the straw buyers, you had these subprime loans, you had these 100% stated loans that were fueling the fire. It was just like putting gas on the fire, because what it was doing is it was creating too many properties and not enough buyers, which in turn, you can guess it, starts affecting the stock market and the banks need to start getting bailed out because people are filing for foreclosure, they're letting their houses go, or they're giving their houses back to the bank because they can't afford to pay for all of these properties and houses that they have. So the subprime loans, not to mention the multiple properties, the rental properties. Some people had 2 to 3 vacation homes. You had exaggerated appraisals. You had appraisers that were being paid off to do fake appraisals or to do, substantially higher appraisals than what the houses were actually worth. And then people were pulling cash out of these houses after they were closing on them and then not making payments on these. Some of these properties for these straw buyers never even had a payment made. So as this compounds with all of the subprime loans and all of the other issues that we were seeing in the market, that's essentially what caused that 2008 market to crash. So now, since 2008, we've seen stiffer loan guidelines, and for most of the lending programs, you're seeing down payments required. The majority of loan programs, you have to have proof of income. You have to have reserves on jumbo loans, subprime loans, and anything outside of an owner occupied. You have to have anywhere from 3 to 18 months reserves, whether it be jumbo, non-conforming, stated income. And if they do stated income now, you've got to put 20% down. So you're seeing more responsible lending. And not to mention on those stated income loans that we're doing now, you do have to have anywhere from 12 to 18 months reserves. So they want to make sure that you have those backup funds. If you have a renter move out and somebody's not able to make that payment, you've got the backup reserves, and they're making sure you have that before they approve the loans. Not to mention, you're not seeing a lot of the straw buyers. You're not seeing appraisals coming in higher than what they actually are worth, because they're scrutinizing these appraisals so much that they're making sure that the values are accurate, and there's actually, and they're just doing double the work they used to do, and they're just not approving anything and everything you're throwing at the bank. So this is why the 2023 market is not going to be as bad as the 2008 market. It's because we don't have as much inventory as we had back then. Not to mention, we have more buyers than we have inventory right now, which is causing a greater demand in the housing market. A lot of people are sitting on the fence waiting for the crash in 2023. Well, I just don't see it. I just don't see it happening. And as far as I've read, according to the Goldman Sachs report, Goldman Sachs has said that this is the biggest correction since 2008, which means that all of the experts agree in 2023 there'll be a huge opportunity to buy a house at a huge discount. Maybe not as big of a discount as back in 2008, but there's still a huge discount. On an average, I've personally done over the last 6 months, I've seen pretty much on every house that I've done, I've seen discounts anywhere from $80,000 up to $150,000 on the discount from what the house was selling at back in early 2022 to what they're selling at this point in 2023. So go out and buy a house, quit sitting on the fence, because as soon as rates start to dip a little bit, these housing prices are going to head back up, and then you're going to miss the boat. So make sure you call an agent, find a good lender anywhere in the U.S., and go find a house and make it happen. Don't forget to subscribe to the channel, smash that subscribe button, and we'll see you on the next video.